Hello, and welcome. We're glad you're joining us today as we embark on an exciting journey into the fascinating world of real estate investment trusts, or REITs for short. Today, we're diving into the world of healthcare real estate and shining a spotlight on a standout company, Global Medical REIT, or GMRE. This company specializes in owning and managing properties that are essential to the healthcare industry, like hospitals and medical offices. REITs can seem complex at first glance, but our goal is to break things down into clear, actionable insights that anyone can understand, no matter your experience level. We'll explore what sets GMRE apart from its bigger competitors, how it operates, and why its recent performance is worth a closer look for investors seeking opportunities in this sector. If you're new to REITs, don't worry, this will be straightforward and jargon-free. We'll explain key concepts in simple terms, so you can follow along with confidence. Think of this as a friendly chat where we uncover the real story behind the numbers and help you see how these investments fit into the bigger financial picture. We'll cover the basics, GMRE's unique strategy, and what it means for investors like you who are looking to make informed decisions. By the end of this video, you'll have a solid understanding of GMRE's place in the market, and you'll be better equipped to evaluate its potential as part of your investment portfolio. Remember, knowledge is the foundation of smart investing. So grab a notebook, get comfortable, and let's get started on this learning adventure together. What's a REIT? Simply put, it's a company that owns or finances income-producing real estate. By buying REIT shares, you own a piece of a large property portfolio, no millions required. REITs must pay out at least 90% of taxable income as dividends, making them a favorite for income-seeking investors. Your returns come from rent collected on these properties, linking your income directly to real estate performance. REITs also offer diversification. Real estate often moves differently than stocks or bonds. Plus, REIT shares are easy to buy and sell, unlike physical property. High yields, diversification, and liquidity make REITs a smart addition to many portfolios. They're a practical way for everyday investors to access commercial real estate. Now, let's focus on Global Medical REIT, GMRE. GMRE specializes in healthcare real estate, owning medical office buildings, specialty hospitals, and rehab centers. Their properties are leased long-term, often with triple net leases, meaning tenants cover taxes, insurance, and maintenance. This reduces GMRE's risk and ensures steady income. Unlike bigger REITs in major cities, GMRE targets essential facilities in smaller, growing communities. These markets are less competitive, offering better yields and high tenant retention. GMRE isn't chasing flashy assets. It's building a stable, diversified portfolio in vital local markets. The focus is on reliability and yield, not rapid expansion. This strategy is key to understanding GMRE's recent performance. To truly understand GMRE's unique position in the healthcare real estate market, we first need to look at its main competitors, often referred to as the Titans: Welltower, Ventas, and HealthPeak. These companies are industry giants, shaping the landscape of healthcare real estate investment trusts, or REITs, across the country. These titans own vast and diverse portfolios, ranging from sprawling senior housing communities and cutting-edge life science campuses to major urban medical centers. Their reach extends into nearly every corner of the healthcare sector, making them dominant players in the industry. Their business models are designed for massive scale and aggressive growth, which allows them to capture large market share. However, this scale also brings significant operational complexity and exposes them to higher levels of risk, especially as they manage a wide variety of property types and tenant needs. For example, senior housing investments depend heavily on maintaining high occupancy rates. When times are good, these properties can be very profitable, but during economic downturns or health crises, occupancy can drop quickly, making revenues volatile and unpredictable. Life science properties, another major focus for the Titans, are closely tied to the ups and downs of the biotech industry. This adds another layer of risk, as funding cycles and scientific breakthroughs can dramatically impact demand for these specialized spaces. The Titans tend to concentrate their investments in big cities and large hospital systems, where competition is fierce and the stakes are high. Their properties are often located in bustling metropolitan areas, serving major healthcare networks. GMRE, by contrast, takes a different approach. It focuses on smaller, stable medical facilities located in secondary and tertiary markets, places that are often overlooked by the bigger players, but offer steady demand and less volatility. By targeting these markets, GMRE avoids much of the operational risk and intense competition that the Titans face. Its properties tend to have long-term tenants and stable cash flows, making its business model more resilient in uncertain times. This specialist approach is the key reason why GMRE's path has diverged from the Titans. By choosing a different strategy, GMRE has carved out its own niche in the healthcare real estate world, proving that different strategies can lead to very different outcomes. Recently, GMRE's stock has lagged behind the Titans, whose prices rebounded sharply post-pandemic. Why? Investors chased growth stories, like senior housing's comeback, rewarding the Titans for their recovery potential. GMRE, with its steady triple-net leases, didn't have a dramatic rebound. Its income stayed stable throughout. Some saw this as boring, missing the value of reliability. Rising interest rates also hit smaller REITs like GMRE harder, making growth more expensive. The Titans, with bigger balance sheets, weathered these headwinds better. So while the market favored comeback stories, GMRE's steady approach was overlooked. It's a classic case of stability versus excitement. But is this gap justified? Three main reasons explain the performance gap. First, the market loves operational leverage. Titans' earnings soared as senior housing occupancy rebounded. Second, GMRE's triple-net leases offer stability but cap upside. Titans can raise rents more dynamically. Third, cost of capital. Rising rates hurt smaller REITs like GMRE more, while Titans borrow more cheaply. The market rewarded the Titans' growth and scale, punishing GMRE's slower, steadier model. But GMRE's reliability hasn't changed. It's just out of the spotlight. Sometimes the tortoise gets ignored while the hares race ahead, but steady performance can win in the long run. That's why GMRE deserves a closer look. Is the performance gap between these stocks truly justified, or is it just a temporary market reaction? When we see such a wide divergence, it's natural to wonder if the fundamentals really support it, or if emotions and short-term thinking are driving prices. In my view, the market's recent moves have been a bit extreme, and that's created a window of opportunity for investors who are willing to be patient and look past the headlines. GMRE's steady, bond-like income stream is being overlooked in favor of the Titans' more dramatic growth stories. But sometimes, the market underappreciates consistency and reliability, especially when everyone's chasing the next big thing. Think of it like this. Titans are like luxury hotels. They shine during economic booms, but can be hit hard during downturns. Their fortunes rise and fall with the economic cycle, making them exciting but also risky. GMRE, on the other hand, is more like a well-run apartment building, steady, reliable, and less prone to dramatic swings. It may not make headlines, but it delivers consistent results year after year. The management team at GMRE has shown real discipline, slowing down acquisitions and focusing on quality deals, especially now that interest rates are higher. This careful approach helps protect investors from unnecessary risk. As interest rates eventually stabilize, GMRE's growth prospects could improve, and the market may start to recognize its value again. Meanwhile, demand for medical facilities is only increasing as the population ages and healthcare needs grow. This long-term trend supports GMRE's business model. Right now, GMRE's dividend yield is much higher than the Titans, sometimes topping 8%. That's a significant income stream for investors, especially in uncertain times. With GMRE, you get paid to wait while the market eventually catches up to the company's true value. That's a powerful advantage for patient investors. This is classic value investing, focusing on stable assets, high yields, and a patient, disciplined strategy. Sometimes, the most boring investments turn out to be the most rewarding in the long run. What's the takeaway? The market often overlooks steady, income-focused companies like GMRE in favor of growth stories. For long-term investors, this is where opportunity lies. GMRE offers a high dividend yield and reliable cash flow, rare in today's market. It's a bet on fundamentals, essential properties, long-term leases, and disciplined management. Consider mixing both titans and specialists like GMRE for a balanced portfolio. The goal isn't to chase the hottest stock, but to build lasting wealth. Look beyond headlines. Understand what you own and why. That's the mark of a smart investor. To wrap up, REITs offer income diversification and liquidity, key benefits for investors. GMRE stands out by focusing on stable, triple-net lease medical properties in secondary markets. Its recent underperformance isn't a sign of weakness, but a reflection of market sentiment. This has created a compelling opportunity for value and income-focused investors. The lesson: think independently, do your homework, and don't just follow the crowd. Sometimes the best investments are the ones hiding in plain sight. Thanks for joining this deep dive. Keep building your financial knowledge. For more insights, follow Tech Monetize. Until next time, invest wisely and stay informed.